Sushant Bhansali, CEO of Ambit Asset Management, joining in. Sushant, very good morning to you and great to have you on India Market Open. Are you also completely enamored with what's happening in the primary market? Do you think it's crazy? Do you think it's a bubble? How are you looking at it? Let me start by talking to you about the hottest topic right now.
Yeah, no, I don't think it's a bubble per se. There are lots of money which institutions are collecting domestically, and they've been sensible in the last 2, 3 years. This time of not putting that liquid float into the markets directly on the secondary side and making valuations much more expensive. They have been conservative. They have been taking, I would say, lots of promoter productivity blocks as well as primary offerings and using the money judiciously. So I would say it's a very judicious use, and that's how capital markets should work. That the money which is being used, that's a primary purpose of capital markets. That money is used for capex. And with the primary offerings, this is how it's going. Now, at times, it can happen that private equity funds will fund the capex and then come to the public markets to get an exit. But ultimately, that's the money which went for capex. So I don't see necessarily it as a bubble. Of course, there are opportunities of opportunity IPO windows. It was shut for quite a few months in the recent past, and that's why once it opened up, I think people were ready to make use of the opportunity, and that's why so many IPOs and probably even QIPs are coming through in a short period of time.
Okay. Uh, do you see it also as an option, IPOs, QIPs, and of course, I would add promoter stake sales to it, a whole host of block deals. Do you see it as an option being exercised to take off the froth by the smart money when the time is right?
Definitely, every seller will try to maximize their gain, and if there's an opportunity and they believe that they're getting good price for the shares, they will always want to use that, and that's what is playing out. It's not necessarily fraud at times. It's just that people believe that the risk-reward ratio is in their favor, and that's why they would rather take money now than do it later. There is end use of that money, and if that's a wise use, why not?
Okay. Some people argue that it's also a Sushant, good morning. Of course, Neeraj here, good to have you. Some people argue it's also the right thing to happen for the ample liquidity to find its place. Now, my question to you is, some of these deals are landing up in some very good hands. Is that also something that a retail investor, for example, should take notice of, Sushant? Any thoughts on that?
Yeah, so broadly, if you look at developed markets, the institutional shareholding is much higher than majority owners or the business owners, right? In the Indian market, historically, the promoter stake would have been 50-60%. And if by doing this, it is coming down, I think it's better for capital markets. There is more stability, there is more liquidity in the markets. So markets are much more efficient in long term, and pricing is also very much efficient. So in a way, bringing the promoter stakes down and institutional shareholding increasing is very good for capital markets in the long term.
Got it. Sushant, how are you viewing markets per se right now? I mean, there has been a good sparkling rally. Is this making India look a bit expensive? Or do you reckon that things are okay on the valuation front and it might be a good time to invest?
Yeah, it's not excessive, I would say. Of course, it's no more cheap the way it was 2 months back in many segments. For between September and February, almost 90% of the stocks corrected. And between March and June, almost 90% of stocks are up as well. But a sum total of that is almost 70% stocks are still below the September levels. So there are opportunities as well. Of course, there are many where the P ratios had gone up to 50, 70, 80 times, and even today they are 30, 40, 50 times. So it's not cheap, but I would say the froth definitely has gone off in lots of segments. Most of the segments, I think, have reported more than 20% offs compared to September levels. And those are the sectors where there are good companies, but because of liquidity reasons, because of which I think the prices melted massively, especially in January and February. Those opportunities are there, and selectively, market is getting polarized. If you look at the last 3 months, even though broader markets have come up more or less, I think just 3 or 4, 5% below the lifetime highs. But as I said, 68% of the stocks are still below September levels. And in lots of segments, the polarization is taking place, that the stocks which are going up are handful, and these stocks have gone up almost 30, 40, 50, 60% as well in the last 3 months. So polarization taking effect, and that's because the economy, I would say, is now stabilized after 2 or 3 very good years. Sorry, FY22 and FY23 and part of FY24, the earning profile was quite broad-based. It is now narrowing down. It is getting more concentrated. A handful of companies are now able to deliver 20% earning growth. If you look at FY22-23, almost every second company was delivering 25% earning growth. But now it has come down to almost every fifth or sixth company. And that's why market is rewarding companies which are delivering performance, and money is moving from weaker companies to stronger companies. So companies which have got good pricing power are the ones which are able to sustain their earning growth, and that's where smart money is now moving.
Is the smart money looking at private banks afresh, Sushant? Just wondering what you're making of it, because
Yes,
you could
I think.
argue they've not participated to the full extent.
Yeah, so I think the smart money participated last year in private banks. I think that's the time the opportunity was. Now everybody is following that. So if you look at BFI segment, I think smart money followed private banks in second half of last year. This year, the last few months, I think smart money has been going on to the insurance side within the BFSI segment.
Okay, Sushant, you guys used to, or maybe you still do, but write some very strong, very good monthly notes, right? About the current theme, about what is it that you guys believe is the first amongst equals when it comes to the investable landscape. What is the theme for July, if you can tell? And if not,
Yeah.
what is
No,
the,
no, why not?
what is the June one?
Yeah, these are public newsletters, so there's nothing private in it. So we're writing on chemicals this month. So we believe.
What's the story? Yeah.
Yeah, so we believe that there are quite a lot of tailwinds on the chemical side, both globally as well as domestically. The inventory levels globally are stabilizing, so there will be a lot of demand, and which will ramp up the pricing side of chemicals. The prices have bottomed out a lot across many categories of chemicals, and the capex cycle is behind us. So this is the time where the cash flows will be, there'll be more free cash flows for the next 2 or 3 years. I think Street is not very convinced on chemical side. They're not too gung ho like they were 2 years back, and they were disappointed over the last 2 years. So we believe time for chemicals has come, and this is what we are going to publish in a couple of days.
Okay. And is there a particular segment within chemicals, Sushant? Because we know it's not a homogeneous sector. So are there particular verticals within chemicals where you guys believe, I mean, I look forward to read to your note, of course, but what will the particular verticals be?
Yeah, there are many. I think agrochemicals is one such where there will be, I think, lots of global tailwinds which will come into play. Monsoons in India as well as globally, I think the rainfalls have been decent, and the inventory levels, more importantly, are at a historical low. I think inventory to sales ratios is at decadal low, and that there are lots of tailwinds in agrochemicals. Alongside that, lots of import substitution opportunities where lots of capex has taken place in the last 3 5 years, and looking at how I would say trade deals are getting negotiated in the last few months, especially chemicals on agrochemical side, mines. Will be, I think, good, and there are lots of import substitution stories. Yeah, I think they will. They have lots of tailwinds in the next few quarters.
Sean, one final question, because a clutch of new listings have come in, but let's assume from a size perspective, the one notable one is HDB Financial. NBFCs have the tailwind with the new Reserve Bank of India moves as well. Is that a bucket to reckon with in the next 12 months? Do you think money can be made there?
Yeah, I think for good NBFCs, the time is quite good. The valuations are not too expensive related to if you look at the last 10-year history, that there are times when the valuations take a knock, and which is what has taken place in the last 2 or 3 years. So it's a good time for good NBFCs because one, liquidity is now more in supply for NBFCs. RBI, which has been tightening on the NBFCs for quite a lot of time over the last 2 3 years. They have in the last few months, I think, sort of softened on them. They want them now to participate. RBI was quite, I think, convinced that unsecured lending was going haywire, and that's why they tightened all these through various measures, and they're now softening it. But more importantly, because of all this tightening as well as the credit cycle period which was going by, the smaller NBFCs as well as I think those who didn't have a solid business model, they are suffering right now, and it's a great field to operate for the good NBFCs for the next few quarters. Credit growth is coming back, and NBFCs will be, I would say, allowed to participate alongside banks equally. That has been, I think, if you look at a few of the actions which RBI has been taking, both in terms of circulars, relaxations, etc.
Sure.
So looks like NBFCs, good NBFCs will have a good time for the next 12 months.
Okay, and good NBFCs will have a good time for the next 12 months. We can't let you go, Sushant, without asking you what you make of IT. No one can quite tell. Is it you have a positive view, not quite positive view? IT stocks up today. It's also unclear what's happening on the US economy front.
Yeah, that's the precise reason why I think IT has, I would say, gone up and then again come down. One news and it goes up, and then another 2 months of, I would say, going down. So it's been tipsy toffee for last 2 years for IT companies. The valuations are in favor of IT companies. I can only say that at this point of time. How the US economy shapes up will determine the future course of earning growth. And you can't, I would say, lose much now. How much you will gain will depend on how the US economy does and how Europe is coming back quite nicely. So companies with good European exposure, I think their earning growth should be much better compared to companies with much better in a sense that of predictability. If US economy continues to do well and the recession is only a fair and doesn't come down that massively, then even the companies with US exposure will do well. Valuations are in favor of IT companies today for sure.
Valuations are favorable in IT companies. Thank you so much, Mr. Bhansali, for joining in today.